Hello traders, and welcome back to another video. Now today in this video I want to talk about macroeconomics and shifts. Okay, let's talk a bit about what happens in the macroeconomics, the bigger picture, and what affects markets. Now with a major focus on the month of September. Now every week or every month we'll be having different themes, weekly themes, where we talk about different things, and this week I want to talk deeply about macroeconomics. Now if you're watching this video, just know that I shot this video a week prior to this week, so if you look at the dates or the charts or what I'm going to show and they're a little bit off, just know I shot it sometime prior. Now the month of September tends to be the most volatile market, or the most volatile period. Historically, US stocks or indices and equities have a negative 1% historical performance since 1950. So why September negative? Now, usually when we're doing market analysis and when we're doing backtesting, we are always paying attention to technicals. How is my system performing? How is my psychology improving? How am I going to trade this strategy or this system? And we tend to pay little attention to fundamentals, macroeconomics. And I tend to believe that those are the ones that have more power, more weight. You know, the system is good, but it is very systematic, and the markets tend to shift. The markets tend to have a different environment, but there are certain aspects that tend to happen in the markets that tend to repeat year in, year out, year in, year out. There are actually very few traders who actually wait for these specific moments, specific times when markets are in a bear market, when market starts having a negative return. That's when they want to come into the markets. Now today I want to show you those stuff. We get deeper. Okay, now I'll talk a bit about it, but I'll get deeper into the presentation and all that we always do in our live trading sessions. We normally have live Thursday sessions in the evening. Those are the ones we get deeper into these topics and talk about it in-depthly and answer the questions you have. But today I'll give you a brief overview just for you to understand what it is that we look at. Okay, now just to state a few facts, okay? Since 1926, September has shown an average return of negative 1%. This is on US equities, the only month with a consistent negative return. Now, sorry for this, because this video has come a bit late. It was to come for the first week or just before September, as you guys prepare to go into September. By the time you're watching this, I think it'll be a bit too late, but still, get to know this, and I want to give you homework in the end that you guys can focus on to do so that you can prepare for the next coming months, depending on the historical data of how markets have been performing, because October and November tend to be one of the most positive months in history when it comes to the equities. S&P 500, one of the worst performing months is in the month of September, with an average loss of 1 to 1.5% negative on most of those years. In Europe as well, for those who trade the Europe market, the Euro stocks have an average of negative 1.5 to 2%. Germany DAX has a negative 1.6%, and France has a negative 1.5% performance in the month of September. Now, what are the reasons for this? What causes markets to do this? Okay, now let me take you a bit back. It's a bit of common sense and also critical thinking. Okay, now if you don't know, I majorly focus on trading indices. I stopped trading forex. I don't trade forex anymore. I trade commodities and indices, and I've given my reasons why in prior videos. So if you haven't watched our prior videos, go and look for them. I explain deeply why I trade indices. Now, you have to think of it like this. During the July to August, June, July, August is normally a break for the Europeans and the US people. They are on what we call the summer break. Okay, nothing new. This has always been. So during summer break, a lot of these fund managers, a lot of people at work are normally taking a break of market. So the markets are not as volatile. Now, don't get me wrong. This is not a fact. Like, it's not cast on stone. Just because on holiday doesn't mean the markets do not move. People normally have this fallacy, and I normally see this a lot. When I started my trading career, people used to say, in December, markets don't move much. You can go on holiday, take a break. My friend, I've seen gold get into new all-time highs a lot of times in December over the past 8 years that I have been trading. So now I really tend to trade based on data, not on what people say about the markets and not what I think about the markets. Okay, but during summer break, there's normally that fund managers. Now remember, volatility, volume, a lot of it from the markets, especially if you're trading markets that are correlated to the US dollar and the pound. Okay, majorly my pairs that I trade are focused on the US market. Now during this period, a lot of fund managers who are not in charge, but rather are the most powerful people when it comes to moving the markets, the market makers, is Europe and US, are normally on a break. When they're coming back from the break, August and September, now September is when they're all coming back, it's what we call the post-summer break rebalancing of books. Okay, post-summer break rebalancing of book or repositioning of the books. Now this is when people come back and they want to come back into a volatile market. Now this tends to be affecting markets psychologically. A lot of people prepare in advance, knowing that September is when a lot of people are coming back to the market. So volatility is going to increase. Now it comes in different ways. There are times markets can come a bit positive, but rarely does it come positive, because a lot of people, as they're rebalancing the books, they want to cash in if they have some profits or what, to end the quarter. Okay, so remember, the second quarter started in July. So July, August, September, which is the second quarter of the year, or the third quarter, not the second quarter, this the second half of the year, and the third quarter, September is the most volatile because July and August tend to be slow. So when they are rebalancing the books, one, they want to take their profits. So a lot of people are profit taking. Okay, when it comes to stock markets, when people are taking profits, it tends to have this domino effect of markets getting bullish, because the markets getting bearish, because the bullish players, the people who are positively long, are starting to take out their positions, which tend to have that domino effect. One person coming out, another person coming out, tends to make the markets go down. So those is rebalancing of books. At the same time, a lot of people come with the positive mindset of, we want to take position, but rarely do people take position, because the third quarter is coming into an end. And remember, stock markets in the US tend to file their stock earnings or their profits or all that revenues during the quarters. Okay, so every quarter they tend to say what profits they've made, what positions do they have, and all that. Now, thanks to Paperstone, Financial Hub is going to be having live trading sessions on Tuesdays every week. Mind you, this is not a signals group. This one will be specifically for anyone who's deposited their money using our link with Paperstone and deposited money in their own account. Now, if you look at the description below, there's a link where you can open a Paperstone account. Once you open a Paperstone account, you deposit either $100 or $250 to get the top tier access to the financial course, which you get to understand how we trade. What will the students gain from all this? One, you'll gain clarity in the process. Patience training. We'll be teaching you a lot of patience training depending on the time frame you trade, the pairs you trade. Risk management in action. We'll be talking a lot about the trade management skills and how I manage a trade. We'll be looking at real market conditions and experience the market as it is, and I'll see you on the other side. Now, this is different for companies. Don't get me wrong. I'm talking mainly about fund managers, not companies. Companies don't come and say, okay, it's September, let's sell our shares and all that. No. Fund managers are the ones who tend to come in, come out, come in, come out. So that rebalancing of books tends to have a lot of volatility in the markets. Now, if you're trading the US dollar, denominations such as the Euro USD, GBP USD, Aussie dollar, USD CAD, indices, and all those gold, these markets tend to be affected, and that's why you tend to see gold also performing quite positively during the month of September as people come out. Okay, sawa. Another reason why markets tend to have that volatility is because of the economic data that is coming out during the month of September. I'll first start with FOMC. Now, FOMC is an yearly meeting that the Feds normally have. Now, the Feds are in charge of monetary policy in the United States. They hold the FOMC meetings 8 times in 1 year. Now, September is normally the third last meeting towards the end of the year that a lot of people pay attention to know what positions to put their books in. Because when Jerome Powell or whoever is the governor goes ahead to speak about what they think about the market, or they think about the dot-com plot, what in terms of if they're going to increase interest rates, reduce them, or maintain them, it tends to give people a good overview of how to position their books as they go into the last quarter of the year. Because as the quarter continues, they'll have the October, and then we skip November, and then we'll have the next one in December. Okay, so this also helps a lot of fund managers know how to position their books, which of course will affect the markets. Many people will sit on cash. If it's a positive thing, they might go into the market and buy different stock markets here and there. Now, I remember it was back in 2021 or 2022, one of the two. I remember when Jerome Powell went in front of the world and sat and talked about increasing interest rates. Now, in an environment where we're increasing interest rates, markets tend to perform negatively because borrowing is expensive, and people tend to sit on cash as a safe haven. Okay, so a lot of people tend to offset their positions, be it in the crypto markets, stock markets, and whatever markets we're talking about. Now, for us specifically that year, we sat down with Ken, and I remember we had a lot of positions in the crypto market. The Bitcoins, the Solanas, the XRPs, the Ethereum, did I say Ethereum? And what have you. So when Jerome Powell went in front and talked about that, I remember we rebalanced our books and decided to sell all our positions in the crypto markets. And funny enough, that is when we had a top. Now, I want to show you this practical example. Okay, now let me come here. So let me start with that. Then I'll go back to the indices. So if you look at this, this is the crypto market. Okay, let me look for that specific time. I remember it was around here. Yeah, it was 2021. Okay, now around September, October, they gave that information that they are looking to start offsetting, or rather increasing the interest rates. Because remember, post-COVID in 2020, we went into what we call ZAP, zero interest rate policy era. Okay, during that time, interest rates was near a zero. It was between 0 and 0.25%, because they wanted to stimulate the economy. They wanted to make borrowing cheap, people to continue doing businesses, people to borrow money, and money to circulate in the economy. So during that time, a lot of money entered into the system, and that's why you're seeing post-COVID, you can see this bullish momentum in the crypto markets. Now, during that time when the Jerome Powell came and said, okay, we've seen the markets are stabilizing, we want to control inflation, and people have really come back into the markets, and business is going on as intended. And now we want to control inflation and all that using interest rates, and they want to increase the interest rates. By increasing interest rates, it basically means borrowing is going to be harder, loans are going to be more expensive, and what have you. So the economy is going to be a bit tighter. Now, what happened during that time? After that news came out, you can see markets started going down. You can even see, I wrote here, markets tried to soar to new all-time highs, but it was short-lived after the Federal Reserve announced their dot-com plot of increasing interest rates to help control rising inflation, which was an aftermath of quantitative easing and low interest rate environment, the ZAP, during the COVID period. So those volatilities tend to come into the markets, and that's why you can see here in September, we sort of had a bearish market. So you can see here, so let me zoom into that. So you can see here, we had a bearish market start of September. So towards here, when we got those interest rates information, you can see markets sort of pushed to the upside before, one last push to the upside before the actual bear market began. You can see how volatile that market was, volatile to the downside, volatile to the upside. Also, VIX tends to normally show during the month of September, the VIX markets tend to really spike to an upper side. Now, if you don't know what the VIX is, it's the volatility index that tracks a couple of markets that shows the volatility in the markets. So now, I had some data here that I'd put for, let's start with the US 100. Just looking at data, at the same time, what I say may be hearsay. So let's look at the data and look at what market performs. Now, we're in the month of September now. I'll come here in a few. If you go back here, this is the US 100, Nasdaq 100. This is 2024 September. You can see 2024 September, we had a bear market. You can see this, okay? This was September 2024. Markets had a bear market before getting a bottom in September, and then we had that bullish run also in September. But we had both markets. We had a bearish run, then we had a bullish run. So it's important to look at that, okay? Just as the market was beginning, that start of September, towards the end of August, markets rebalancing, people coming back into the markets, bear markets, then we had that bullish upside. You can see even markets from this low to this high, markets had a 61.8% correction before we got that bullish run to the upside. If you come a bit further, you go back here, this is 2023. You can get to see we had a bear market in September. The whole of September was in a bearish market. We bottomed at the beginning, not actually even bottom, because markets went further down. Towards the end of October is when we had an actual bottom, okay? So we tend to normally see those bearish markets in September. If you go a bit further behind again, you can get to see here, data-wise, we're using data. September tends to be quite bearish. You can see this is 2022 September bear market, and markets just fell all the way and got a bottom in October. So you can see those are 2 years consecutively. We are seeing October and September were quite negative on the Nasdaq 100, not all markets, getting that bottom and pushing to the upper side. So November tends to have quite that bullish information. And those are things we're waiting for, because I am a net bullish trader. So I'm looking for those corrections during this time of September and October, using data, using historical fundamental data as well as technical data to understand when to start positioning, when to avoid markets. It's not just about looking at pivot points, looking at key levels, looking at moving averages. No, look at historical data, because at the end of the day, it is traders who are trading, and traders are human, and human are predictive in nature because they're habitual species. They tend to repeat themselves, and that's why we have psychological levels, psychological months. Markets tend to repeat themselves almost impeccably year in, year out when it comes to certain scenarios. If you go to the US 500, which is a major market you need to look at as well, you can see here in September we had a bit of a bearish market. Okay, so this was September. We had a bit of a bearish market. Then we had a bullish market. Then sort of consolidation. Then we had a bullish markets to the upside. And then if you come here back to 2023, we had a big bearish market. That was 2023. If you come to 2022 as well, you can see here we had a big bearish market. Okay, and last but not least, if you look at US 30, US 30 tends not to have that volatility of US 500 and US 100. If you put them on a scale, US 100 is on the far right with extreme volatility, and US 30 is on the far left with least volatility but highest volume. It has a lot of volume at the same time, but it tends to move not necessarily highest volume, okay? So don't get me wrong, because they are weighted differently. They're not weighted in the same way. And I've talked about this in a previous video as well, but US 500 tends to be in the middle. Now, US 500 is very important to pay attention to, because that's how we track the US economy. It has the 500 largest company in the stock markets from the United States, from all sectors. It doesn't just specify one sector, because if you look at Nasdaq 100, it specifies the sector. It's only technology and telecommunications companies. When it comes to the US 500, it has a basket of many types of companies from different sectors, okay? So if you look here, back here, 2024, we had a bull market. It wasn't actually a bear market. Market actually topped over here towards the end of September. But if you go a bit further behind, sorry about that. If you go here, we can see we had a bear market in 2023 September. And if you go further behind, we even have another bear market in 2022. Now, those are data you can go look for yourself if you go further behind, okay? So what does that mean during this period, okay? If you look at the current markets, like personally, I'm waiting for markets to, maybe by the time you're watching this video, because I'm shooting the video a week after, a week before, markets would have gone down, or markets will have gone to a new high. But I'm anticipating markets to come a bit lower to get this flag pattern and other things that I'm looking at in order to get this bullish buy. So that's what I'm looking for on this one. So I'm anticipating this month to have those bearish markets or bearish volatility to the downside on the US 30. Same thing I'm looking at on the US 100. You can see this, the same thing. I'm looking for more bearish markets to come into the markets in the next coming weeks. If not, markets will go to an all-time high, and that's fine, but that's what I'm anticipating. I'm anticipating markets already had a bullish face, a bearish face. Okay, markets were down last week and they strongly pushed up, but the month is still new. Today is the 9th of September, so I'm still anticipating more bearish markets, as well as the US 500. US 500, I don't have any pattern forming or any trade I'm waiting for on this one, but if it gets that bearish momentum, it's in line with the rest of the other Nasdaq 100 and US 30. So those are a few reasons why markets tend to have a bearish face, and I don't want to talk too much here because I tend to give more data, more information during our Thursday webinars, which we hold every Thursday from 7 to 8 p.m. So be sure to come for that, because that's why I'll be explaining much more about that data and explain much more about how markets move depending on the markets you're watching, because when it comes to currencies, that's a whole different market. But me, I tend to focus on the US 100, US 30, US 500, and the gold markets to give me that analysis. And you can see I tend to get deeper because I focus on very few pairs and I go deeper and understand it at a deeper level. And I still believe there's so much to learn. What I've learned is just a tip of the iceberg. There's so much more I can learn, and there's so much more I can teach you. So be sure to come for the Thursday webinar and we'll talk much more about this stuff. So thank you for tuning in, and I'll see you in the next video.